Hi. Every business plan that I've looked at in any of the startups I've looked at calculate their business plans assuming that the dynamics of real life business processes can be approximated this way. Take the variation between weeks where you sell at your upper expected amount, weeks where you sell your lower expected amount, calculate from that the expected growth rate, and then drag that expected growth rate out across the 10 years of your business plan. And so you take this to the poor investor and say, dear investor, we offer you a doubling of the business every year. Of course, the better ones do something a little bit better than that. They recognize that you need to build in the sensitivity correctly, coming from the variation week to week on how much you actually sell. And so they've put in an upper and a lower expected growth rate for the business and say to the investor, well, we might not quite double in size every year. We might end up more than doubling in size every year, or we might end up at 30% less than a doubling in size every year. However, even this is not good enough. What is far better is to build into your business plan a way of estimating the real life dynamics of real life business processes, so that when you take your business plan and say to investors, this is what we offer you as the return on investment over the next 10 years, you're basing that on a calculation using real life dynamics. So let's take a look at what happens if you build into your business plan the real dynamics that happens in business processes, looking at it from a week by week basis, where we build in some weeks are good weeks, some weeks are bad weeks, some weeks are average weeks, but you cannot predict which week is going to be which in advance. All you know is that on average, you'll work out at approximately the same number of good weeks and bad weeks, or whatever is appropriate for your business. As you can see here, this leads to a significantly lower return on investment than the normal naive business plan predicts. Of course, what you see here in this white line is one possible sequence of business performance week by week. You can't predict what that sequence is going to be now, 10 years into the future, and you actually have no control over what that sequence will be. So to get an even better idea of what might happen, we need to look at a wide range of possible outcomes on a week by week basis and the impact on the working capital of your business. So here you see 50 different universes that your business is equally likely to move down as it progresses through the next 10 years. You have no way of controlling which of these lines is the line that your investee will move down, and as it moves down, you have no way of controlling or changing from one line to another. So the appropriate thing to do to make your business decision is to work out what is the expected outcome, what is the most likely range for your business, the company you're about to invest in, to move down. That's what you see here. The yellow line is the expected outcome using the correct dynamics of real life business. As you see here, you should expect this business to go bankrupt within 10 years. In the worst case, it goes bankrupt in 2 years. In the best case, it's not yet bankrupt at the end of 10 years, but it hasn't actually delivered any meaningful return on investment by the end of the 10-year cycle. The first moral of this story is make sure that you use the correct dynamics in your business planning, the kind of dynamics that leads to the yellow line prediction, rather than the fantasy dynamics that lead to the red line prediction for how your business is going to perform over 10 years. This mistake in business planning is part of the reason why businesses tend to chew through far more financial capital, human capital, and natural capital than they actually need to deliver a certain return on investment. It's also one of the reasons why investors are actually leaving money lying on the table. Investment funds could perform significantly better, which is crucial in today's age where we need businesses to really step up and address the challenges that we're facing around climate change, resource depletion, all of the things that impact businesses, net positive, regenerative businesses, circular businesses are here to do. This is the secret ingredient that can enable businesses to perform well in regenerative, impact, circular, and so on. Well, the first thing that is typically done is to increase the profit margin. In this case, we need to increase the profit margin by a factor of 5 if we're going to get back to the doubling in size every year that the naive business plan promised to the investor. Now, that invariably means screwing down the costs, raising the profit margin. The second thing, of course, that we could do is change the laws of physics. However, that isn't going to work at all well. There is a third thing that we can do, which is depicted here. Here you see the correction factor that Steve Jobs, perhaps unintentionally, built into Apple with his biggest innovation of eliminating different product and departmental budgets, putting everything into the same bank account. And this is also the reason why multi-product companies like Procter & Gamble, Nestle, Unilever tend to perform consistently well. There is a level of collaboration between the brands within a multi-brand company. If you look at Apple, there is a high level of collaboration across the entire company for the good of Apple as a whole. If you're an investor working with a portfolio, what this means is that each individual business will perform better if you build in some appropriate level of collaboration, of sharing between the different businesses in your portfolio. If you want to know more about how this works in a practical sense, get hold of a copy of my book, Rebuild the Economy, Leadership and You, or sign up for one of our workshops for investors.